Welcome to the Big Skinny with me, Lou Basenese, your host with the most, I hope, today, coming to you from our studios in Brooklyn. We're talking about a retail rebellion, an AI mania that keeps on raging on, and the Fed's got a problem today. We thought we had a problem Friday, too, with a bad jobs report. The market sold off, but lo and behold, it's a Monday, a fresh start to the week and fresh highs. But before we get to all that, let's get to what we're all about. If this is your first time joining us here at the Big Skinny, you're probably going, what is this name about? What are you guys doing? Well, the Urban Dictionary defines it as insider information. We are absolutely not that, not looking to get ourselves in trouble. But what we are is the essential truth, the most important things you need to know about the markets, because let's face it, we're all inundated and overwhelmed with information from all angles in this market, in this world, and how does anyone ever make sense of that? Well, that's what we're here for. We want to sort through the noise and the clutter and give you each week the information that matters to increase your bottom line. Some people call us the Sports Center of financial news. I'll take that. We're kind of like a highlight reel of things that matter. Others have referred to us as the Dave Portnoy of pizza reviews, but for investment news, because everyone knows Dave, one bite, everyone knows his rules. We take a similar approach where we distill down the key market fundamentals and actions to take in one headline that you should probably ignore, one key chart that has the data that tells you where the profit opportunity lies, and one investment insight so that, let's face it, you can increase your bottom line and we can along the way as well. Because if we don't make you money here and we don't make ourselves money, we're not going to be here for very long. We do that each week in our rundown with 3 of the key topics, but along the way, we also offer you the opportunity to join the conversation, change the direction of the show if you so choose and dare. We're streaming live on multiple social platforms, so do not be afraid to chime in on those comment sections, whether you're on X, Twitter, as an old guy, still have to refer to it, LinkedIn, YouTube, even Rumble. So we'd love to hear from you. No comments are out of bounds. We may just fire back if you get a little cheeky. So please don't hesitate to do that, and don't hesitate to sign up for our newsletter as well at thebigskinny.com. I do want to let you know we're going to be covering a lot of topics before we get to the rundown. We have a special guest this week, Chris Camillo of DumbMoney TV, Laughing at Wall Street. It's a gentleman that I met, it dates me over almost 12 years ago, the first time when he was disrupting the markets and what Wall Street thought was normal performance from retail traders, and he's done it exponentially more since then, and looking forward to having a conversation with him about one of my favorite topics that I'm still a skeptic on, humanoid robots, and then everything else in the markets and more. Along the way, we're obviously going to be sharing some compelling investment picks. So let's get started right now with this week's rundown. Throwing punches as we start with this week's rundown here. Powell absolutely got punked. I mean, if you look at the Wall Street Journal headline, he said the labor market looked solid at last week's Fed meeting. That was coming out of Wednesday. And lo and behold, on Friday, what happened? Well, we got a really disappointing jobs report. Way below expectations. Even worse, revisions for the previous 2 months were revised way lower. If we look at it, it almost negated all of the gains. But funny enough, even though Powell and the data shows that things are not all well on the labor front, New York Fed President John Williams came out later that day on Friday after he had the new data in his hand and demonstrated his loyalty to Jerome Powell, saying, what we're seeing, I would describe over the past year, is a gentle, gradual cooling of the labor market, but still leaving it in a solid place. Excuse me? No, that's not how anyone else sees it. If we look at the charts here, these are major revisions downward, all aggregating in the near term here. So you look at those shaded areas, that was the original high bar for the numbers. The darker areas is where the numbers came down to. Who knows where July will be revised lower to? So much so that the president stepped in and fired the head of the data miner behind this, the head of the BLS. Now, here's what I need to really drive home. A single data point that's out of line could be an anomaly. A trend, though, is really troublesome. And if you look at the trend there of increasing revisions downward, it brings back that ADP employment report for June that seemed so off the mark. Remember, it was reflecting a negative 37,000 jobs, right? And we said this was such an outlier. It was standard deviations away from standard deviations away. But guess what now? After the revisions, it looks like ADP was actually not that wrong. If we look at the trend over a more holistic approach as well, you see that the job market has been cooling. It's just leveled off here since about December of 2022 by industry, right? We've got the private education and healthcare sectors, leisure and hospitality, government, obviously that pesky employer that we're trying to reduce has leveled off. But look, the trend here is not the Fed's friend. It makes it really clear that the Fed has one move to make, and that is cut rates. Now, that might sound counterintuitive coming from me because I have been a stalwart saying no way the Fed's cutting rates anytime soon. The market is in good enough shape. But guess what? The data, and the Fed is supposed to be data dependent. We are data dependent here. The data is changing. And if we look at this week's money chart, you see it compellingly over a 3-month rolling average of monthly non-farm payrolls over time. Hi ho, off to work. Maybe we don't go here. Focus on that dashed line. I mean, it's falling off a cliff. And I said long ago when I was being adamant that the Fed wasn't going to cut rates, it was too early to cut rates, that the one thing that could change my mind was a cooling in the labor market. Well, folks, the freeze is upon us. I think the Fed will get a couple more data points before the next meeting in September. They're going to be forced to cut rates either by the president or the fact that one of the Fed presidents just resigned, leaving an opening spot. That would open up the door for the president to appoint another Fed president that could be the third dissenting voice. We're headed lower from here. We showed the chart last week that shows we got plenty of wiggle room. If you look at the 1-year Treasury yield and subtract out the trailing 12-month CPI, we've got about 100 to 125 basis points of wiggle room. So the Fed can cut and start their cutting. I'm going to bet on that now happening in September. I know it's going to surprise. It surprises you because I was adamant it wasn't, but that's what I think is on the horizon. About 80% of futures trading suggests the same thing. So bet on it, get ready. Later in the show, we'll cover one of the areas of the market that should benefit the most from the first Fed cut. So moving on, what about AI? What's the latest? We had just had big tech earnings for the last 2 weeks. Palantir kicking off this week's earning bonanza. And already the people are out in the headlines trying to scare us out of the AI trend, right? Business Insider with this one, the stock market's dangerous AI bet. We're all betting on the future of tech, and it could run into an economic reality. Oh, really? Which reality is that? That it's going higher? I'm not sure what Business Insider is looking at. And I've noticed this with the media. As things go better and more favorably for us, particularly retail investors, they're always trying to find the potential angle that could be negative, that small outlier of a risk. They can't just embrace it when growth is for growth's sake. And folks, I don't know how to demonstrate this to you any more clear than just looking at the data behind AI. I mean, last week we showed you Alphabet's chart, its runaway growth in cloud revenue. In fact, one of the biggest quarters that they had, adding $5.3 billion in annual recurring revenue growth for Google Cloud. Well, guess what? Since we talked about that, Microsoft reported their growth in the cloud segment. Same thing, almost $5 billion added. Look at this chart. This does not look like a trend that's petering out. It's accelerating, going up and to the right even more than we can anticipate. If we look at it all, just the quotes, I like to think about this. You look at some of the founders behind Google Brain and Coursera saying AI is the new electricity. Pick up Peter Diamandis, a futurist, right? He's got the benefit of making predictions way out in the future. If they don't come true, he's probably dead. But I think he nails this one. There's going to be two kinds of companies at the end of this decade. Ones that are fully utilizing AI and the others that are out of business. Folks, if we think about the electrification of the world, which began over roughly 150 years ago, that endured. There's still 675 million people without electricity today. This AI trend is going to have similar staying power, and I'm going to point you to the data that proves it. Just look at the investments that are being made by the biggest tech companies, what we call the hyperscalers. It's accelerating, right? This, for whatever reason, Fiscal AI wanted to invert this chart, but if you imagine mirroring it and it's going up and to the right, it's the capital expenditures. They used accounting terms here, so it's the money these companies are spending, so it's a negative. But in the last quarter alone, $88 billion spent on growing AI infrastructure. Now, if we update the money chart we showed you about a month ago when we unleashed our top 10 AI stocks not named Nvidia, it shows a dramatic increase in the spending, right? So the blue lines And the light blue is the original estimates for this year's CapEx on AI. And now you have in the bold blue, bigger. You got Meta going from 72 billion to 100 billion. You got Amazon going from 100 to 105. Go across Microsoft with a huge jump. I mean, Alphabet from 80 to 120 billion. And I'm sorry, that is Microsoft. Yeah, I get my logos mixed up sometimes, but bear with me, it doesn't matter. The trajectory is still the same. They're spending way more, and here's what you gotta remember. These are companies that are deciding. This is not speculation. This is not some analyst saying he thinks or she thinks AI spending is going up. These are real life, real world companies investing tens of billions of dollars more than they thought last quarter in a trend that's going to persist for a lot longer, which brings us to the investment insight that you have to invest in AI or your portfolio is going to die. You've got to find new ways to find AI investments. We shared our top 10 lists of companies that aren't named Nvidia. If you can't remember those, some of those are Teradyne, Symbotic, Samsara, Innodata, Core Scientific, Oddity. We cover the gamut here. It's not just chip makers, it's test and equipment makers. It's logistics companies that are levering AI into their existing businesses. It's pharmaceutical companies, it's companies developing actual skincare lines, and companies even developing new drugs and biology, synthetic biology 2.0, which will actually work with exozymes like it didn't work with so many of the first round of synthetic biology companies. So my point is this. We're always on the lookout for top 10 for AI picks. It's not just Nvidia, it's not just Palantir. You should be doing the same because we're going to keep bringing them to you here. Which brings us to our last but not least rundown point. It's never too late, right? It's never too late to buy into the new trend. It's never too late to buy into some of these top companies. Now, that may sound counterintuitive and say, Lou, I don't want to be the greater fool and be the last person to the party that just top ticks it and it rolls over. Well, we have an interesting market phenomenon that I want to bring up. And I remembered it because of Apple in this headline saying like, hey, Apple had a big earnings surprise, but a small move. Is it time to buy? Well, look, everyone here knows that I'm a huge Apple fanboy. I've been just a huge proponent of it. I don't actually think Apple's a great buy right here, still trading at about 26 times forward earnings. But it does bring up a key point that it's never too late, even on the heels of a great earnings report, to buy a company. Here's why. This is one of the phenomenons that's been studied in the markets the longest, going all the way back to 1968. It's called post-earnings announcement drift. It's the tendency for companies that surprise positively or negatively with their earnings report over the next 60 to 180 trading days to keep trading in that direction. The gains increase. So if we look at these, we call them triple plays. Bespoke makes it really easy to find them, the bespoke triple plays, but we call them drifters here, right? So these are companies that outperform over the long term. If you look in the far right column here, these are all the companies that beat earnings expectations, beat sales expectations, and raise guidance. You only see a handful that are down year to date. So these are the steady performers. I always say that as earnings go, so goes a stock. If earnings keep increasing, stock prices will keep increasing. And if you look at the post-earnings announcement drift for companies over time, you can add an extra 5 to 8% over what the market does just by focusing on these companies. So as the market hits new all-time highs and people freak out, that doesn't mean you should be looking to pile into the most overvalued companies. It does mean you should be looking to pile into the most consistent performers. And you can wait for that information. You can wait for perfect information. Wait for the quarterly reports. That's it for this week's rundown. Don't forget to sign up for our newsletter at thebigskinny.com or scan the QR code that comes up on your screen periodically. We'll be right back after this word with our first guest, Chris Camillo. Do you believe everyone deserves access to quality healthcare, regardless of their financial situation? I certainly do. And at the Roberto Clemente Health Clinic, we make that a reality. I say we because I've been lucky to be on their board of directors for the last 5 years. We're a US-based 501c3 nonprofit that's dedicated to providing affordable, compassionate medical care to the 30,000 people in the coastal communities of Nicaragua and the Tola region. If you didn't know, Nicaragua is the second poorest country in the Western Hemisphere, and these people do not have access to the things we take for granted. Now, I've seen, as a member of the board of directors, I've seen firsthand the profound impact the clinic has on lives. They provide a full spectrum of services, including primary care, pediatric care, urgent care, and wellness education and services in the community. All donations directly support the mission, allowing us to continue offering these vital services. I know there's a lot of great causes that are clamoring for your attention and your dollars. I'm just asking you to check out a new one to consider making a difference today. Learn more about the NICA Clinic at nicaclinic.org. Together, we can build a healthier, stronger community. We'll be right back.
Let me get your thought. I was talking to Adam Johnson this week, and you know Adam.
Yeah.
And I asked him, listen, do you want to book profits at this point? I mean, such a big move, Adam, off that April low.
Yeah.
And Adam said, no, I'm not booking. I'm staying long. And I said, okay, why? And he said, well, it just comes down to the 3 E's for me. He said, earnings, employment, economy. As long as they're solid, I'm staying long in the market. What do you make of that viewpoint?
Yeah, I actually have to agree with him. It's not because we're friends. My 3 E's would be earnings, earnings, and earnings. For me, that's always what matters. And so I'm looking at those names that are trading at a low earnings multiple that are still reporting really strong growth. So I look in the semis. I don't love Nvidia. I own it, but I don't love buying it here. I don't love Palantir. I like a name like NXPI that's trading at like 19 times forward earnings, more attractive. Looking in the biotech sector, companies like Halozymes that are at 12 times earnings that are more of a pick and shovel play. So yeah, I don't think there's anything that gets in the way of higher prices from here, but I don't think that's a justification to just chase momentum and just pay any price for it. Welcome back to The Big Skinny with me, Lou Basenese. We're here digesting what the market's doing. We had one comment before. Don't forget to chime in. We're streaming on multiple platforms right here. Someone asked what my thoughts were on Palantir. Well, I'm still trying to figure out what exactly Palantir does. It's kind of a black box technology that we're really not sure, but I can tell you this, it's a booming business, right? They worked for the defense industry primarily in the early days, and now they're starting to branch out, and they just did $1 billion in revenue in a quarter for the first time ever. So this is a stock that has gone parabolic. If you look at it over time here, 1 year, 5 year, it hasn't had that Nvidia type move yet. I would say that I was late to the party here too, but look, Palantir, if you're playing the AI trend, you have to have a position in Palantir, you have to have a position in Nvidia. So we're gonna talk all that and more with this week's guest, Chris Camillo. Let's bring in Chris right now and get right into it. Chris, glad to have you on The Big Skinny, my friend. Long time no see.
Yeah, happy to reconnect. It has been over a decade.
Yeah, it's wild, man. That just means you and I are old and everyone else is young, right?
Well, we're staying young at heart.
Yeah,
man.
listen, I said this when I sent out the email telling people about today's episode. You had your finger on a strategy and an idea when social media was just taking off called social leverage. You've leveraged that to take a portfolio from about $20,000 to north of $50 million. So no one can argue with your results. Talk to us about just how you see the markets, how you operate in the markets, because people that aren't familiar with your approach, I think it's important for them to hear it.
Yes. To be clear, I call it social arbitrage.
Okay.
But it's essentially observational investing, and it is really simple. It's all about trying to surface change in the world quicker than others, and then trying to connect the dots of that change back to companies and sectors that would be the key beneficiaries or key, I guess you can say, in the other side companies or sectors to be harmed by that change, and then you make your trade. And
Yeah,
of
and then
course,
how
it's
are
more,
you finding these, right? It wasn't the normal, it wasn't Wall Street reports that you're looking for. It wasn't the Morgan Stanley banker. Where were you finding these data points to connect the
no,
dots on?
no, I surprisingly consume almost zero financial media of any kind. You kind of have to look for alpha in places where others are not spending their time. So as opposed to kind of just being part of the herd. So these days, I guess the last 6 or 7 years, the majority of my alpha comes off of comments on TikTok. It comes in other places as well. It could be Reddit, could be X. Back in the early 2000 teens, it was more on X or Twitter at the time than anything else. But people stopped expressing themselves on X. It's become more of a news
Yeah.
and a politics platform as opposed to like, what are you buying today? What are you doing with your time today? Like, that's not what people discuss on X, but people are really open and passionate and on TikTok, and essentially the entire world unfolds in real time on TikTok if you know where to look. And it's not necessarily just watching videos, but it's about reading the thousands and thousands of comments. So I spend about 4 hours a day consuming what I call conversational data that lives on social media.
And then
And it's
what's
really
the
just,
trigger points for you, right? So you're spending 4 hours, you're kind of just bathing yourself in what the chatter is in the market among people, real life people that are making decisions, that are driving businesses. When do you start to, like, what are the signs that you go, hey, this might be an investment, the nugget of an investment right here?
yeah, so it's when you come across something. It could be a trend, it could be something. It doesn't have to be like a consumer trend. It could be a shift in technology, something that's happening with the weather. It could be something that's happening in politics. It could be any change that you say, you know what, that change is going to be really impactful to this company or set of companies, either in a positive or negative way. And the real difference maker is when other people have not yet fully acknowledge that change as being real for one reason or another. First of all, you have to make sure the change is a needle mover for the company, right?
Right,
Because
right.
it can't be a monstrously big company and a tiny little change that's going to impact, maybe 1/10 of 1% of their sales. It has to be meaningful. So when you find something that has potential to be meaningful in terms of to a company's revenue or a company's cost or just the perception of a company, and it's not fully acknowledged by other investors, and there are not other things happening at the company that are meaningfully more important than the thing that you surfaced, well, then you have the makings of what I call a social arb trade. And this is something I've been doing now for about 17 years. And now there's not just me. There's like a whole world of
Yeah,
people. It's
you
crazy.
got you
Like
got
they,
Skip Bayless, who's a fan too. He says you're the GOAT, so he must have traded alongside you in some here. Just
Oh my
to
goodness, I had no idea. Like it's wild to me how often I see people in communities like surfacing that talk about this type of trading, and that was always my dream. It's like not for me to control it or to own it,
yeah,
but I just love that this is something that anyone can do. You don't have to be financially pedigreed in any capacity. You don't have to be kind of a math whiz. It's not technical trading. It doesn't have to consume your whole life. It's something you could do like off hours. You could do it for
yeah.
fun. You could just you learn to retrain your brain to observe the world differently, to pay attention, and to connect dots. That's
Yeah.
really what it's all
Look,
about.
it's situational awareness that they use in the military sense and law enforcement, but for the markets, and I think you put a finger on it, like it doesn't have to consume you like the world says Wall Street, you have to be an MIT math grad whiz. Like, man, you can be the dumbest dumb money around, but have the greatest common sense and be able to sense this stuff and profit alongside you and these
Yeah, and
ideas.
we call ourselves, our YouTube show is called Dumb Money
I
Live,
love it.
and we call ourselves Dumb Money only because that's the term that people have used against us for so long, and we wear it as a badge. Like technically, we are considered dumb money, but yet I'm going on, I want to say my 18th year of audited portfolio track record where I'm averaging somewhere between 70 and 80% annualized over the past 17, 18
So,
years now. And it's
dude,
something I'm,
that is insane because
I,
I came out of the traditional world and to democratize access to information, good ideas, 70 to 80% annualized over 18 years. even if we layered in a standard hedge fund fee of 2 and 20 on that, you're still going to be the top performing hedge fund manager of all time, up there with the greats. And they would say that's not possible.
I always want to put a disclaimer out there because I am friends with a lot of hedge fund guys, and like I don't manage billions of dollars, and what they do is inherently more difficult to do when you're dealing with that type of size.
Of course.
You know, the portfolio that I manage is 8 figures, not 9 and 10 figures. So it is somewhat easier for me to do what I do.
Yeah,
but listen,
you got to be proud of it, man, because I mean, Buffett had the quote like, look, I know, no, in fact, I can guarantee you that I would double your money every year if I was only managing $1 million or $2 million, because he knows that he can find arbitrage opportunities with that size and move around quickly. So you've done it. I mean, not just once or twice, but 18 years in a row, which is one of the reasons I wanted to talk to you too, because I'm part of that skeptic class on humanoid robots, right? I believe it's real. I definitely think it's here. I've always been an early adopter of tech. But when I see Morgan Stanley put out a chart that says like, oh, by 2050, it's going to be generating $5 trillion worth of revenue, but next to none for the next few years, I'm like, all right, if I'm early, that means I'm going to be wrong. So it's a timing issue for me. So what got you over the hump to say the weight's not going to suck like we have here in our chart, that it's actually going to be a profitable weight? And where are you playing it mostly? Is it with Tesla? Is it with an ETF? Like, give me your whole humanoid robot transformation or conversion story.
Yeah, first of all, like I think it'd be odd if you weren't a skeptic, unless you've kind of seen what someone like myself has seen and has had the type of fortune and exposure that I've had to the industry sector. I don't blame you at all for being a skeptic. I was a skeptic. You know, I met one of the founding teams of Humanoids 7.5 years ago.
Oh, wow.
And year after year, I refused to invest in the company because I was a skeptic. Looking back, how lucky was I that I just happened to cross paths with these kids so long ago that when it became real, I just happened to be in the right place, right time. I think that Morgan Stanley report is like actually super conservative in the long run. Like I have really, I have opinions here that are not in line with some of the other people in the sector. I am way more conservative in the short run than almost anyone in this sector is. I'm over 500 hours of deep research into the humanoid sector. I've engaged with most of the humanoid companies on Earth, either directly or through someone in my close network who has been closely evaluating them and has been on the inside. I have, probably more alpha on the sector than anyone in the finance industry. So, I can't say everything that I know.
Yeah, no, I understand that.
All I can say is that I engage with roboticists globally nearly on a daily basis now.
So would you ever thought you would say that 5 years ago, 10 years ago? I'm engaging with roboticists.
It's like almost half of my life and has been for about 2 years. And I fell into it again as a skeptic, just like you. I will tell you this, it is extraordinarily real, but most of the information that's being floated around in financial circles is just flat out wrong, misunderstood.
Yeah.
2 years ago when I started talking about this, nobody believed me. Now everybody has become way too aggressive on their timelines, unrealistic, and just patently wrong with what they think is real and not real. And like I'm very close with all, I wouldn't say, I'm not going to say all, many of the largest investors globally in this space that are invested privately have become my friends now. And listen, everybody has their text chains. I'm on a text chain with all, and we're sharing alpha. We're sharing intel falls daily.
This is awesome because now you have a new friend group when the robots take over all the rest of the world.
Yeah.
Hey, so how do you play this now? How do you balance this? So you're definitely more constructive on timing. Any stocks that, I mean, obviously I saw you think Tesla could generate $10 trillion worth of value eventually from this trend, but how do you play it from a stock trend? Because I look at some of the new humanoid robot ETFs and they got a lot of exposure in international companies, right? Japanese, mostly robotics companies, some Chinese companies, which are not easy for US investors to get access to. Are you playing at public stocks, private investments? I'm assuming you're spreading the bets around some names.
I don't love any of the ETFs as someone that understands the space really well.
Yeah.
There are I mean this could be a multi-hour, if not multi-day conversation. But I'll try to be effective and stay at a high level. I'll just say this. There are an enormous number of humanoid labs around the world and very few companies, like actually almost none. Like I can count them on less than one hand, how many real companies in the world in this space. So there's really only one way for retail investors to invest in one of those humanoid companies.
Don't say it because
And
you're
it
going to
would
say
it
Tesla and it's going to
well,
violate
well,
everything in me.
it would be Tesla, and ironically, I'm not invested in Tesla yet for their humanoid program. I've been getting a lot of heat because for a long time, people have been asking me, "Hey, I wrote that tweet thread on at Chris Camillo on Twitter, like in late 23. I think I posted it in January of 24, and it was about how the optimist sector of Tesla could be valued at 10 trillion by end of 2030 by having a million other humanoids in
Yeah.
circulation for commercial and industrial work. I still feel that that's a possibility, but the Optimist program is not what people think. It's not doing as well as people think. I've known for about 7 or 8 months that they were not where they wanted to be.
Yeah.
I
Which is
think they've
typical
made some.
Elon, right? Overpromise and then backfill to deliver,
I
hopefully in a reasonable time
I
frame.
I think Elon, like a lot of people know, he's been spread thin, but he still has to kind of say what he needs to say to keep people excited. I don't think Elon even fully had a grasp of what was happening at Optimus. And it's so funny because like a lot of the stuff I've been saying for the past 6 months privately to people that, hey, no, Optimus is not making 10,000 bots this year. I don't think they'll even hit that 5,000
Yeah.
that they wanted to hit. And it's because it's not ready to scale. That Optimus was never ready to scale. As it's come out over the last few weeks, there's a number of issues. But you know what? The craziest thing is, none of this should be a surprise. I keep telling people we are a developmental stage sector right now.
Yeah,
We're not
absolutely.
a scaling, this is not a sector to scale today. It never was. Certain CEOs are going to say what certain CEOs need to say for the reasons they need to say it. But
It's
if
the
you
cost
want
of
to know,
capital, Chris. We need to not dilute
I
ourselves crazily. Yeah.
I know, but like, listen, from a guy who's on the deep inside here, I'm telling everyone, this sector is not even remotely ready to scale yet. Okay, does it mean that some companies won't attempt to scale for a number of reasons? They might still attempt to scale, but we're not there yet. And when you see a company like Tesla with the issues they're having with Optimus, all of this is to be expected. I don't
Yeah.
see any of it as like a huge negative for Tesla long term. They're one of three companies that I think are meaningfully real right now. All right, in the space, and they have more resources and more money than anyone.
Yeah.
So I feel that Tesla is still in the pole position to be in the leadership here of humanoids over the next decade to decade and a half, which is what actually matters. Uh, we have a lot of problems to solve with humanoids. By the way, when you say you're skeptical, can you tell me the top one or two reasons why you're skeptical? Because I'm sure a lot of the people watching share that concern, and I would like to address it
Yeah. No,
again
man.
because a lot of people just they don't get the sector. They don't
Yeah.
understand what's actually
Flipping the
happening.
script on the interviewer, you're interviewing me. I love it, man. True to form. So, look, I would say this. I've been early on robotics, industrial robotics. So, like symbiotic cognition, different like vision technology and factory automation. Really looking at that. So, I believe in the capabilities. So, I'm skeptical that, like, if we can bring up the chart eventually here, the whole humanoid robot stack. It's a convergence of all these technologies and an integration that I just don't think technologically we're there yet, that we haven't connected all the, for lack of a better term, the middleware to make this all function seamlessly where it can scale. So it's, for me, we're not there just yet, but we're getting closer. And the faster the AI trend ramps up, the more adept we're going to be to connect all this and have the interconnectivity. That's the biggest thing. And then also price point, right? So like, I think not a perfect analogy, but 3D printing, the first 3D printers were like 150 grand. And then you saw very quickly we drove that price down to like sub 1,000, which leads to adoption. So for me, it's a cost curve and then just the technology innovation curve. So not yet there. So those are my big objections.
Okay, so like I think that's really fair. If you say we're not there yet, what is your level of confidence that we could be approaching there in the early 2030s for the bipedal humanoids?
Yeah, no, I would say that I don't foresee that there's any reason we couldn't get there by the early 2030s, right?
Yeah, so and by the way, I didn't mean to skip your last question. The way that I am playing it, I'm invested across a handful of companies that are all private that touch the sector. Two of them are actual bipedal humanoid companies, Apptronic and Figure AI. They're private,
Yep.
right? Obviously, there are ways to trade private shares for retail investors these days, but it's a little more difficult than trading a publicly traded company. um the middleware, right? And some of the issues that we're having with dexterity of hands, with the completion rate of tasks, with the uptime of the bots, with the durability of the bots to be economically feasible. You really need these bots to have like a 3 to 5 year durability.
Yeah.
There are a number of things that have to fall in line. I will tell you this. We are not there yet on any of those things, but there is an engineering sightline to getting there in the very near future.
Yeah, I
So,
think you said a key point there. It's an engineering sightline. For me, it's not an innovation issue, it's an engineering issue, right? These are solvable problems, which just means how can you estimate the timeline, right? So, yeah.
yes, I thought what you were going to say in not believing in the sector is that why humanoids, why bipedal, why not precision robotics, which is where we've been the last 50 years. And I think that's an area where people just fully don't understand the market, right? So when we think about automation, when we think about what Amazon is doing and other bleeding edge companies, um, precision robotics, uh, it's hard to envision a near future in the next 25, 30 years where precision robotics can accommodate more than 5% of the automation companies desire.
Yeah.
And the reason for that is anytime you have precision robotics, the workflow and the operations have to kind of revolve around the robot itself, right?
Right. It's
Where
not a natural where you have to redesign the whole implementation. I mean, we got a question here from Prince Hakeem, who I know well. He's Prince A. There's not a Prince B. He wants to know Amazon, Walmart, heavy in logistics, maybe humanoid robots. I mean, that makes headlines. Amazon's almost got more, robots than employees. Do you see these industrial powerhouses at the front line of the humanoid robot trend, or you just see them in the background really helping develop the infrastructure to make the humanoids possible? Because if we look at the trend, right, industrial robots, if you look at this chart here, have scaled pretty impressively with 500,000 deployments worldwide, where humanoid robots really are just in the infancy. So is it
yeah,
is it like the defense sector brings us into the new, like the industrial guys bring us, humanoid robots into existence, but it's different players?
They're two completely different industries, and
Yeah.
the scaling that you've seen with industrial robots are nothing compared to what you will eventually see with generalized robots when you have something that's relatively close to a single SKU or two or three SKUs that is being refined over many years.
Yeah.
And you could actually have millions, hundreds of millions, billions of the infinite labor machine that could essentially do anything. There's a sight line into us having that machine ready and scalable now. So it's two completely different industries.
Yeah.
Amazon is going to explore their own generalized robot. They're behind. They're not a bleeding edge uh, company in this space today, but perhaps one day they will. Apple's getting in this market. OpenAI is getting in this market. Meta is getting in this market. Obviously, Tesla is already in it with Optimus. Essentially, all of big tech over the course of the next 20 years, I strongly believe will evolve into becoming hardware companies,
Yeah.
unlike we've seen in the past, because the embodiment of artificial intelligence, the hundreds of billions of dollars that these companies are currently investing in in essentially the models, right? The intelligence need to be monetized. And there are a handful of ways to monetize these investments. And one of the biggest ways to monetize these investments is through the embodiment of
Yeah,
this
it's a good
intelligence.
point. I mean, they're developing the brains first, and then they've got to put it into a body to monetize that.
That's exactly correct, but also understand that physical labor is somewhere between a third and 50% of global GDP. Why? Like, why is it so big, such a big part of global GDP? And that's because, most of the world's problems and functions in manufacturing and logistics and warehousing and it's all revolves around human workflow
Yeah.
today. And actually changing that takes many, many, many decades and a massive amount of money. And it's just not something that is going to happen quickly at all. So if you think about this over the next few decades, we have to solve these problems with existing infrastructure.
Yeah,
And the
so
way to do
that's the
that,
bottleneck is the infrastructure, right? Because you got to rip up basically like you're going to change the mode of transportation from railroads to flying or cars to flying cars. It's just you can't do it
no,
overnight. It's not
no,
possible.
no. And so we are going to start with a generalized bot that is relatively similar to the existing physical workforce, which happens to have two legs and two arms and a head. And it will be working with humans. I'll say something because I know a lot of people, this is a touchy subject. I can say with absolute confidence that the majority of early customers, and it's essentially all major incumbents of physical labor, are the reason why they're excited about this space is not to replace humans. They want these, believe it or not, they want these devices to help grow and expand and have certainty around that expansion of industry over the next 2 to 3 decades. The goal is to reposition the humans that they have to be more productive. So rather than having someone spend a 40-year career moving a piece of sheet metal from 1 foot behind them to 3 feet, in front of them,
Yeah, shoot me right
they
now
would
if that
be
was my
doing,
life. Yeah.
yeah, I mean, they'll be doing something slightly more complex and interesting, but we would have bots to do the repetitive work,
Yeah.
right? So there's just an enormous amount of demand in the hundreds of millions of humans that we are going to fall short between 2030 and 2035. So what is pushing all this demand is the shortage, right? It's
So just
not the
you're talking about the
replacement of
aging
humans.
population. We're not going to have an able-bodied workforce in a lot of these developed nations to be able to perform these manufacturing tasks.
It's a combination of two things. It's an aging workforce, but also shifting demographics of humans that have a desire to do these jobs anymore. Okay,
Yeah.
and it's a global problem that needs to get resolved. And even though these robots are very expensive, somewhere between $100,000 and $200,000 to hand build today, there is certainly a sight line. It's debatable, but there's a sight line that takes them somewhere down between 50 and $80,000 a bot. Now you hear Elon saying 20K, 25K once we get into the millions. It's certainly possible, and I think we'll get there in time, but we don't necessarily need to because we will have bots that are mass manufacturable within single digit years at a 50 to 80K price tag that have a 5-year timeline. And the value of these bots that ranges, but the value of these bots will be somewhere between 100 and 300K a year of human equivalent value. So if you just kind of crunch those numbers, we have an industry sector that has demand today or in the short digit years of hundreds of millions of bots on an annualized basis that will have something close to software margins.
Wow.
Okay.
Yeah.
We've never seen an industry this large. And unlike software, there's a pretty significant moat for those companies that have the capacity to scale because there's not just a moat in terms of the software, the brain, the software stack. Most people underappreciate how massively complex the software stack is outside of the AI brain,
Right.
right? That's controlling the bot. And you have to have fleet management. I mean, there's just so much involved.
Which is the reason why it's going to take the time for it to roll out. So I'm not.
Boom, exactly.
I'm
You just
late, but
nailed
not
it.
really late because there's so much more runway here for the forces that need to come into work and the replacement of infrastructure and the coordination of resources for it to play out.
So the bottleneck here, the ultimate moat and the value creation is in the last mile.
Yeah.
So the company that has the capacity to actually deploy, starting with 2 robots, growing to 200 to 2,000 to 20,000 over time, that is an incredibly difficult problem. And you can't just be a lab. You have to have thousands of employees. You have to have years of strategizing and synthesizing onboarding strategies with these incumbent companies like Walmart, right, FedEx, and like Coca-Cola. This is a difficult problem to solve, and you need to solve it with hardware, with software, with artificial intelligence, and also just with massive amounts of human implementation and strategy. So that's what when I tell you that there are many labs and many YouTube videos with cool robots, but a very tiny number of companies that are doing the unsexy work behind the scenes to actually be able to facilitate the onboarding of robots, not next year or in 2 years, but in 2028, 29, 30, and well beyond. Okay. And those companies are going to be really exciting. And then when you think about the fact that big tech wants to get in on this game in a very big way, again, not necessarily tomorrow, but over the next 5 to 10 years, there's going to be a lot of value. I mean, you think it's interesting how Zuck is making billion-dollar pay packages for
listen,
like an AI scientist?
He's going all in. He's playing No Limit Texas Hold'em for a second time with this pot. So I mean, like,
well, let me
more
just
so
tell
in
you,
the metaverse.
let me say this. If you think it's hard to find an outstanding AI scientist, do you know how hard it is to find a bleeding edge, generalized robotics humanoid
It's easy,
scientist?
man. I'm going to steal your phone. They're on your text thread, man. You're in your group chat.
I mean, I engage with them. I mean, these guys, give it a few years, you're going to see something happen with embodied AI that is very similar to, not even more impressive to, what we've seen with the large language foundation models out there. So this is like the next thing that's going to happen. And it's not just guys like Elon and myself saying this. It's Jensen at Nvidia, right? Like it's people that they really. This is not like some out there thesis anymore, and Wall Street is always slow to kind of acknowledge things that are this big of a shift.
Right.
It is coming. I've invested a lot in this sector privately, and
let's leave
I'm
it
prepared
there.
to invest a lot publicly too.
Yeah, no, let's leave it there because you were not wrong. We could talk for hours about this. And what I've taken away from this conversation is I'm not too late. There's a lot of development that needs to be done. We should probably touch base with you since you've spent the man hours. I mean, 500 plus hours of deep dive research. You got a finger on the pulse. I'd love to have you back as key developments happen in the space, as maybe some of these names like Aptronic and Figure AI make their way towards the public markets, perhaps, if you're game for it, man. Always appreciate your insights.
It's going to be a fun few years ahead for embodied AI, robotics, humanoids. We are barely scratching the surface. The only thing I would warn people of is keep your expectations in check for timelines. Because what you think is going to happen the next 12 to 18 months probably won't happen. But what you think is going to happen in 10 years is likely to be way bigger than you could ever imagine.
Love it. Well said. Couldn't articulate it any better. Appreciate your time and your insights, Chris. Looking forward to catching up again soon.
Thanks, guys.
All right, there you have it from the front lines. This is what we're all about here. We talked about it before. We be humble or be humbled in the markets. When we're skeptical, we're not sure, we bring on people that have done the work, that have spent the time, that have the insights that we don't have to help us get ahead, a step ahead. So look, I've got a lot to think about here, just like I did on Bitcoin, just like I did on the Fed when data dependency came around and the data changed. And now with humanoid robots, a very articulate definition of the problems and the opportunities coming from Chris Camillo, a man who's done it in multiple other areas of the market and sees this as one of the biggest trends. So we're going to keep an eye on this for opportunities to share with you, and then also keep Chris close as other key developments materialize. But before we come back for the last segment of our show, we've got a couple words about a new segment that we launched last week. So let's get to that. Last week, we introduced a new segment called the Young Entrepreneur Spotlight, and we featured Kennedy Joy Forrestall, founder and CEO of the Raid app. It's a peer-to-peer clothing rental app that's taking college campuses by storm nationwide, scaling to over 20 campuses this fall. If you missed that interview, I encourage you to scan the QR code on the screen and check it out. Kennedy Joy is truly an amazing young entrepreneur that is destined to do great things. Keeping with that spirit, we want to give back and keep investing in these young guns that are shaping our future. And we'd like to do so by featuring more of them on future episodes. So, do you know someone young building something bold, smart, or just plain scrappy? Well, we want to hear from you, even if it's you. The Big Skinny's on the hunt for young entrepreneurs with a story to tell, a business to grow, and a little hustle. Well, all right, I'm from Jersey, a lot of hustle in their blood. Whether you're running a startup, a recently launched new business, or something totally out of left field, if it's yours and you're making it happen, we want to give you the opportunity to be featured on an upcoming episode. We support young businesses because we know how hard it is to get the word out. So let us give you the mic. Know someone? Nominate your friend. Running something cool yourself? Reach out and give us your pitch. You can DM us or email us at marketing@thebigskinny.com. That's marketing@thebigskinny.com. And let's get the Big Skinny on you. All right, coming out of break here, we're just going to skip the break and go right into our Dodd Block and tell you first, though, make sure you subscribe to our newsletter at thebigskinny.com or scan this QR code on your screen. Now I'm going to welcome in the Dodd Man. What's up, my friend? Look, last week you got promoted from the intern to a full-time position, and now you got a new office? You spent that bonus check on a new office already, buddy.
Well, first bonus check, I guess I kind of jumped out there just, we didn't talk about my salary, but I just thought it was time I should up my game here. So yeah, I stepped it up a little.
Nice. Well, I sent that Kohl's cash in the mail. It should be getting there soon. Don't spend it all in one place, man.
Uh-oh. I think everything's going to have to go back here, brother.
I sent you some crypto in your wallet, some bonk coin and some other crap coins that we had, trivia about that one week. You're loaded, brother. Don't worry.
All right. Time will tell.
Listen, what'd you think?
That was a lot.
Yeah, well, that was a lot to digest. I mean, I agree the time, but what's your takeaway from it? I mean, humanoid robots, where are you at?
I mean, I'm a little scared, to be honest. I mean, but just from all that, and but Chris is obviously, he's got a wealth of information there. I do think that it's going to be a while. Like we're talking about. I think it will be a while, but I don't know.
2030, he said, where it starts rolling out. Yeah. So we got a good 5 years before the robot takeover. We got to live it up, man. We got to scale the Big Skinny quickly before the robots take over. Yeah, I wish we, would love to gotten his take on the whole concept of leasing a robot that I think we heard last time. That had me thinking that's a possibility. But yeah, that's a good point, right? $50,000 to $80,000 price tag, but you can lease it for under $1,000 a month. I think that probably gets scaled pretty quickly. But another thing I do want to talk about quickly is that young entrepreneur, spotlight. I'm definitely excited that we're doing that, looking to give back and looking to find some other great talent. I was looking at the last show and Kennedy Joy, she's got a head on her shoulders. I mean, yeah, she must be really good parenting, don't you think? I mean, at least from a mother. The father, forget it. Fathers always screw up. No, man, listen. But, the biggest, the smartest thing she said, she disdains the Florida Gators. I mean, that really told me right there. Yeah, Look, I was going to say something nice about you in case people didn't connect the dots that your last name is Forrestall and hers is. But she is truly a remarkable talent, doing great things, coming from two great parents. So I'll give you some credit, but I'm giving Jen most of the credit for raising her that way to be so entrepreneurial. But well, bigger picture. I hope we do get some, get some other great entrepreneurs, and look forward to doing that in the future. Yeah, if anyone knows young people doing wonderful things, we want to hear about it. We'd love to talk with them, chat with them, feature them on the show. So please don't hesitate to connect with us on any of the socials. Email us at marketing@thebigskinny.com. and we'll make sure it happens. We'd love to feature a new young rising star once a month if we can do it. So we know there's enough of them out there. We just got to find them. We got to get in touch with them. So let's go to this week's high five before we run out of 5 minutes to do it.
Let's do it.
All right, we're high-fiving, man. What are we talking about this week? I see it down there. I think I remember everything. We're in good shape. 5 minutes, five topics, right or wrong. Here we go.
All right, too big tech. It's got to either be Mag 7 or some boy band analogy. So hit us. What do you got?
Am I getting predictable? No, too big tech. I'm just playing off that theme of working on the railroad, my friend. Everyone's arguing
railroads.
The railroads, that's right. It's the new big tech trend. We're just don't realize it. No, everyone's saying like tech is taking up too much of the market as a percentage of total market cap. But then this gem comes out, I think it's from Bank of America, showing that the railroad and railroad stocks in 1881 took up 63% of total U.S. stock market cap. So based on where tech is at right now, it's about 38%. We got a long way to go before big tech runs out of its big running room. So yeah, let's. No one uses the railroad analogy often enough, but let's bring it back into fashion.
Leave it to you, Lou. All right, temper your tantrum.
Bank of America. Yeah, temper your tantrum. That's right.
It's got to be Trump related and tariffs, right?
No, man. It's between the two of us. We have eight kids, and I think we've learned how to handle temper tantrums, right? I mean, I would say that's what it is. No, look.
Some of us are dealing with that a little more than others right now.
Some of us, yes, have younger children, so we'll see. No, all these tariff tantrums, we've been talking about it here on the show for weeks, that people are overreacting, overestimating the direct impact on the markets. And I thought this chart really drove it home. If you look pre-August 1, post-August 1, and even take out the exemptions, what happened with the EU tariff rates, and it went from 12.9% to 13.4%. So next to nothing. Like, that's a 50 cent increase on your pint of Guinness. That's really not going to stop you from ordering it. Sorry, man. I'll still take 2 every time I can and every day, right? There it is. Dan, the man with the sound. But so everyone's freaking out. Look, here's my key. There was a lot of uncertainty at the beginning, at the outset. We now have tariff and trade agreements with 19 or 20 countries and counting. China is forthcoming. India is being forced to be forthcoming. It's all going to happen. The EU fell into line. So the impact is going to be offset by the deflationary impact from AI. So nothing to be throwing tantrums over anymore, which is why I think you see the market's not worrying about tariffs anymore.
All right. Great margins. If we're talking about profits, I'm sure we're not talking about my portfolio. So what are we talking about?
We are talking about profits. Everyone always talks about earnings, but here's something I want to drive home is, right, as profit margins go up, it creates even more of a buffer to absorb tariff impacts, right? We've been talking about who ends up bearing the brunt of tariffs. It's actually not the consumer. Companies are going to do everything that they can to absorb it, to avoid eroding demand for their products. Look at these margin profiles for S&P 500 companies on a forward basis. Marching higher, you saw the downturn through COVID, but now we're north of almost 14%. So that's a lot of wiggle room for them to absorb some, transitory inflation impact from tariffs. So earnings are in great shape. Profit margins are in great shape. All-time highs are coming week in and week out until something happens that we can't anticipate yet.
Once again, I hope you're Nostradamus. I hope this is coming true, man. All right, small caps, big error. This does not sound good. What?
No, look, I've been banging the table on small caps, right? And I have to be constructive here. They're now trading at the deepest discount. And the gentleman that shared this chart on X was saying, like, hey, if you've been banging this small cap table since 2019, the discount has just gotten bigger and bigger, and you've been wrong. And that's fair. I agree, right? So I want to temper my enthusiasm for small caps to say that as much as I'm convinced we're poised for outperformance, they are performing better. It could be one of those where we have to wait. There's no way to know the time and the day and the hour exactly when they're going to start launching much higher and outperforming large caps, but they are performing very well right now. I think when the Fed cuts rates, that's going to be the tell. If you looked at what happened with the small cap Russell 2000 index, as the Fed was doing its meeting on Wednesday, right up until the point they ended their comments, the Russell 2000 was up 1%, and then it dropped 1% when it was clear that they weren't going to cut rates. But then we got Friday's jobs report that shows we're going to cut rates. Small caps are most exposed and most sensitive to interest rates in the U.S. So I think we're going to be sitting pretty towards the end of the year. But I want to be fair and balanced. So, I could be wrong. We could be waiting a little bit longer.
Well, if we have to wait, are we talking like humanoid robots timeline?
No. We're talking about 3 to 6 months. That's it.
Oh, okay. We can handle that. We'll hold you to that. Let's come back to that. All right, 99 problems. I know you saw your ex this weekend.
99 problems, and pension ain't one. So listen, this is just one of those weird things. When I was at Morgan Stanley, I remember this was always talked about in the news, underfunded pension liabilities. People are probably like, what? What does that have to do with anything right now? Here's where it comes, the rubber meets the road. Pensions are fully funded. Not many people have them, but the companies that still offer them are now in a surplus. That means they can start being more speculative with their pension assets. Not a lot. Even if they adjust and get more aggressive with 1 to 2% of those assets, could lead to a lot more money coming into the public markets. So yeah, 99 problems and pensions ain't one. Thanks for that reminder, my friend.
I was off. I was way off again.
Thankfully off. Definitely have Chris back. This was so informative. Listen, we want to thank everyone that stayed in and tuned in for the show, including Vanessa and the thousands of other people that were here. Huge fan of anyone who hates the Florida Gators. We got a Dodd supporter in the house. We're running out of time, but just tilt to your left, Dodd, and show them that UCF helmet in the back. Yeah.
Go Knights.
Yeah. It'd be better if you were the one that actually wore that. So maybe one show will make you lose a bet and you'll have to wear it throughout the show. But we'll get to that.
Another story, another day. I had one of those on at one time.
Yeah, another story, another day. Well, listen, we will be back another day, next Monday, in fact, at 5 p.m. Eastern. Thanking you all for joining in on another episode of The Big Skinny with Lou Basenese, the Dodd Man. Our incredible crew here in the studio, Dan, Taylor, Sam, and David. 2 interns here. We're growing leaps and bounds. Let you know we're going places, and we're glad you're coming with us. We'll see you next week. Lou Basenese, Dodd Man, we're out.
See you, Lou.